Today we have Jaakko, and how do we say your last name?
Kooroshy.
Who is going to talk to us about some research that he and his team at LSEG did looking at carbon intensive debt. Why don't you tell us a little bit about what you do, and then we'll get started looking at your research.
I'm the global head of Sustainable Investment Research at the London Stock Exchange Group. Many people are not familiar with the London Stock Exchange Group. It's a big financial services provider. A small part of our business is actually running the exchange in London, but that is today just one of the many things that we do. We are one of the largest data providers in the world. So the old Thomson Reuters data, Refinitiv data, that is part of our business today. We also have index businesses, FTSE Russell franchise. Many people in the US will know the Russell indices. So we calculate those. We have a big post-trade business, settlement business, really span a range of different activities. And within that, we have a research team, or we have many different research teams. One of the teams that we have is focused on sustainable investing, as we call it here. And that team is a global team ranging from New York to Singapore and some places in between. And that's a team that produces research, and the team that I'm heading out.
Tell me about this research you did that goes all the way back to the year 1900, and how did you do that, and what your findings are? I think the numbers are staggering.
The exercise that we're trying to do here is actually quite a straightforward one, which is asking, okay, well, carbon intensive businesses, how much traded debt do they have in fixed income market, and how reliant are fixed income markets on carbon intensive businesses? So in order to answer that question, you have to go through a few different steps. First, you have to define what is a carbon intensive business to begin with. And so we use something, a classification from the Transition Pathway Initiative that basically defines a number of carbon intensive sectors. There's no secrets here. It's the utility sector, power generation. It's many businesses in the transport sectors like airlines or autos. It's obviously the oil and gas industry, the mining companies, etc., chemicals companies. And we effectively looked then at all of the companies that are classified under those sectors, and then we look at all of the debt that they have issued. This is where this gets a little complicated, because there's a huge amount of fixed income instruments that get issued every year. Actually, when we're looking just at last year, there were over 35,000 carbon intensive debt instruments that were issued, and that's just in 1 year. To be able to systematically track this carbon intensive debt, you need a bit of data science, and some of the colleagues that helped to write this paper are actually data scientists and have built an algorithm that allows us to track these things. So one is we have a lot of different issues, but we also have a lot of different issuers that provide that debt into the market. Typically, it's very easy for us to classify something as carbon intensive if it's an oil and gas company, for example, that has issued this debt. But in many cases, it's not the parent company that issues that debt. It can be a special purpose vehicle or a subsidiary. And that subsidiary, think about a car company, and they have a leasing business and a subsidiary that issues that debt. Conventionally, the way that the fixed income market would look at that, it would actually think of that as a financial company, a leasing company, right? A leasing vehicle would be a financial company, and that debt would be attributed to the finance sector rather than to the car company. So one thing that we did is, in these algorithms, go through these quite complex issuer trees and allocate that debt to the carbon intensive sectors. Now, when we do this, what we find, there's actually quite a lot of debt out there that is linked to carbon intensive businesses. So we find in total $5.5 trillion outstanding. And so that allows us then to really start thinking about carbon intensive debt almost like a mini asset class, right? And we can start asking the questions like, how long is the tenure of these bonds? What currency were they issued in? What kind of ratings do they have? Et cetera. When is the maturity date, et cetera, et cetera. So, and that becomes kind of part of our research on carbon intensive debt, and that's really what the report covers, if that makes sense.
That's very interesting. So nobody else has pulled things apart in this manner before, as far as you know?
Well, I mean, first you need the access to the data, and we actually, as part of our other businesses, we maintain one of the largest databases of bonds in the world. As you mentioned, some of the bonds data goes back all the way to 1900. So you need access to a lot of this data, and then you need a way to systematically trawl through this. And as far as we are aware, and discussing this with many clients and stakeholders, we're not aware of this research having been done to this extent previously.
How did you define a carbon intensive?
There's a lot of complexity there. For example, how do you define a debt security, right? What qualifies a debt security, and where you kind of draw the line? You can always fight about these definitions. I don't think actually they make a big difference for the aggregate picture. What we find is that, fixed income markets compared to equity markets, where this question has been studied a lot, are significantly more carbon intensive. So if you take all of the carbon intensive sectors together, they make up a little bit over 20% of global equity markets. If you look at the fixed income market, it's almost 30%. Definitions might change those numbers slightly, but the big picture really doesn't change here.
What do you see as the implication of your findings?
There's an awful lot of carbon intensive debt out there. And what are we saying really here? What we're saying is that this is debt that whose repayment is contingent on the success of business models that today have a lot of carbon in them, right? And as we know, a lot of these sectors are going through a complex transition. Now, how fast that transition goes and how far that transition will go is something that a lot of people have different opinions on, and we know that especially across the pond, that's a very controversial subject. We know that the autos industry is changing with electric vehicles. We know that the utility sector is changing with wind and solar and other renewables coming in. And we know that there's other sectors, the oil and gas industry, the mining industry, airlines industry, that are probably going to face that type of a transition in the future as policymakers and society is trying to work out ways to decarbonize. As an investor in that debt, investors need to take a view on and price this in to some extent in the fixed income market. Now, what we haven't had before is a systematic way to understand, okay, what extent of exposure does your fixed income portfolio actually have to these carbon intensive businesses? What does that maturity profile look like? How are these bonds rated, etc.? And that's really the tool that this research provides. And what we show in the aggregate, right, that there's an awful lot of this debt out there, $5.5 trillion outstanding, right, that it makes up a large part of the fixed income market, almost 30%, and that almost half of that debt needs to be refinanced before 2030, right? And so those are big numbers to throw around, and so investors need to take a view on that. So especially for the longer term bonds, right? So if you negotiated a 30-year bond for an autos company in 2003, probably the low carbon transition wasn't a big part of your calculation at that point. If you refinance that in 33 and you want to keep that same term until 2063, right? What happens with the transition will be crucial, right? What is your exposure to combustion engine cars? Are you operating in a lot of jurisdictions like the US or Europe where petrol engines might be banned in the course of that bond maturing? So as an investor, you have to take a view. Companies need to take a view, and that is some of the questions that we are exploring in the report.
As they're taking a view, what could be their responses?
Investors and companies legitimately take different views on the transition. There's a lot of uncertainty here about how fast and in what sectors the transition will play out. But what we're saying in this report, that if you're a fixed income investor with a long-term time horizon, this is a question that you're not really in a position to ignore. And actually, it's quite interesting that when you look at these bonds in aggregate, we find that on average, carbon intensive bonds have a higher credit rating than other types of bonds, right? That they have typically longer tenor, that they're typically larger in size, right? And a lot of that makes sense against the backdrop that, you're often talking about physical businesses with very, kind of well visible cash flows, right, tied to physical things. But again, some of this may have to be rethought. The risk profile may need to be rethought, especially if you're thinking about that kind of a long-term debt exposure.
Is this what you're calling transition risk, which you just described here?
Absolutely, and the one thing that I always say is that the transition has been actually motoring on for a long time, right? If you think about European utilities, the whole competitive landscape got changed 10, 15 years ago. The lighting industry, nobody ever talks about the lighting industry, but it's actually the first industry where we see a very rapid low carbon transition playing out when we're moving from incandescent light bulb to LEDs, right? Now, this has happened in the past, right? But if you see what's happening in the auto industry today or the utility sector globally, and we will have other industries like the oil and gas industry, airlines, others that are facing that transition coming towards them. So understanding that is very important for investors.
So I assume the data set is a tool that investors can use, correct?
So, we already provide a lot of data on fixed income markets, indices, etc., to clients, right? This is still at the R&D phase, if you want. We've developed these algorithms within our team, but yeah, sure, these are playing also into client discussions, and clients want to understand, okay, well, for my portfolio, what is the exposure for carbon intensive debt? And these are kind of conversations that are going on. I think another interesting aspect on that is we looked at this fixed income exposure. We also kind of asked, okay, who has issued this debt? And one of the things that we see, it's not only publicly listed companies, right? But it's also private companies, and it's also state-owned enterprises, right? And actually 2/3 of carbon intensive debt comes either from privately held companies or from state-owned enterprises. And while, there is very public debates among investors around, the transition plans of Shell or Ford, when it comes to these private companies and these state-owned enterprises, we know much less about what their transition plans are and how they're dealing with this transition risk, right? So I think that's another important thing to focus on. Also, we see increasingly, carbon intensive debt coming that is issued in emerging market currencies, that is non-rated debt, shorter term debt. And so, there's an interesting set of questions also around that, and trying to understand, well, where is that exposure and who holds that? Who is really the counterparty to that carbon intensive debt, if that makes sense.
What about banks? Will this affect the banking industry at all?
We're looking here at publicly traded debt, really, right? I think there's a similar question to be asked, and certainly, there's people looking into that. What does this mean for the loan book of banks, right? Now, you're talking about different data sets here. We're talking about publicly traded fixed income versus loan books, and we haven't done a similar analysis on loan books of banks, but that same issue is at play. If you're a bank whose commercial loan book is mainly, let's say, in the mining industry, well, you have to think about what does the transition mean for you.
How does all this affect the green debt market and the green bond market? And then when we look at transition bonds, which are kind of controversial right now, how does this change the picture?
There's been a huge amount of attention on the green bonds market. The green bonds market is now pretty big, over 3 trillion outstanding. But actually, if you look at it very closely, not all of that issuance comes from corporates, right? You have governments, municipalities, others issuing green debt. And if you look at the corporates that are issuing green debt, actually carbon intensive businesses make up a fairly small share of that. And actually what we found surprising is that green debt, if you want to call it that way, still makes up a fairly small part of the overall issuance of carbon-intensive businesses. And it's mainly businesses like utilities and autos, where the transition is kind of in full swing, that issue a lot of these green bonds and transition bonds. So you actually, if you look at sectors like aluminium or the oil and gas industry, green bonds make up less than 1% of their overall debt financing, right? And so that raises some interesting questions, right? Are these businesses perhaps not transitioning or not committed to the transition, or it asks also the question, well, what happens if the transition accelerates in these sectors? Is there perhaps, scope for very rapid growth in these green bond markets? So there's a lot of interesting questions tied to that. And really, what we do here in the report is that we bring this data set together and do some interesting analysis on it. But I would say that, in many ways, the report raises many more questions than it actually answers. And, we certainly expect this to be a kind of conversation that continues with our clients and also other stakeholders. It's interesting. We've gotten questions on this from regulators and central banks and many different stakeholders that want to understand this aspect better.
I'm not surprised at all. It's it's interesting to think about. There's so many pieces in this puzzle of the transition to net zero, and here's just another piece coming up behind. So thank you for your very good work looking at this data set, and thank you for your time talking with us at John Lothian News.
Excellent. Yeah, it was a pleasure, Sally, and look forward to talking in the future.